Hey, it's Anthony Pietrobono here, back with another finance video. And in today's video, I wanted to talk about a quick way to research growth stocks to see the potential of which growth companies we should actually be investing in. I post educational stock investing videos 3 times a week. So if you're interested in learning more about stocks and investing and building your wealth, then consider subscribing. Today, I'm going to share 7 things to look at before you go ahead and actually invest in a growth company. If you find this video useful, please give it a thumbs up. It really helps the channel grow. I appreciate it. The best growth companies are companies that disrupt the current market. They're new players in a specific industry that have a different approach that revolutionizes the entire industry. That is the ideal growth company. The main thing we need to look at is innovation, the rate of innovation. The definition of innovation is a new idea, method, or device. Now, these 7 metrics to look at aren't in any particular order of importance. I'm just going to tell you them each one at a time. The first one is going to be the moat, and that is going to include what they're currently innovating on. What industry are they disrupting? What gives the company that edge to disrupt the market? After doing some digging, if you're unable to find solid evidence of a company going ahead and doing something different and bringing something completely different to an existing industry, then that's a red flag and we may need to skip this company. A great example is using Tesla. First company to come out and be an all-electric vehicle company. Second is the vertical integration, the only auto manufacturing company to vertically integrate. Another area of innovation is to be the only car with over-the-air software updates, making the car better as you go with age, but they also disrupt themselves. That's the ultimate innovative company. A company that innovates so quickly that they disrupt the industry that they just joined, and then they disrupt their own disruption of the industry. The point is to look for something they're doing that's different, new, and exciting that changes the current industry. That is one way we can look at a moat. Now, I'm going to recommend a book that will go into detail with all the different moats that there are. The book is Phil Town's Rule Number 1. Once you read the book, you'll be able to look at companies and automatically identify whether they have a moat or not. The first of 5 moats is the brand. Tesla has a massive brand. They have the largest brand. Elon Musk has 38 million Twitter followers. Tesla is the most recognizable brand. When you go to buy a car, you don't say you're buying an electric car, you say you're buying a Tesla. It's the same thing with Kleenex. Kleenex made tissues, but when you wanted a tissue, you said, can you pass me a Kleenex, not a tissue? That's when you know you have a moat with your brand. Essentially, you're willing to pay more for a product because of the brand. You know this with plenty of clothing companies, but at this point now, we know that Tesla has the most superior electric cars, hands down. So if you buy an electric car, you already know, well, I'm not gonna buy any other car. When I want an electric car, I'm just gonna buy a Tesla. The second type of moat is a secret. It's a special kind of patent that one company has and another company doesn't. An example of this would be Tesla, where they just came out with a patent on auto summon. So they patented their summoning process, meaning that another car can't copy their auto summon. Auto summon is when you're far away from your car, you parked it, and you just come out of the mall and you press a button, and the car will come out of the parking spot automatically and drive to you so you can get in when there's no one in it. Tesla has a patent on that. That would be an example of a secret. Plenty of other examples, but you get the point. Something that is special about one company that they have patented that another company can't copy. That's another example of a moat. The third moat is a toll, and this is the ability to basically have control over the market. Tesla is in the process of doing this. They're gonna come out with a new way of building batteries at scale, and their plan is to actually do 2 things. Provide batteries to all of the other companies as they grow into the electric vehicle market, and offer their autopilot system as a subscription base to other auto manufacturing companies. So they'll license out their technology to other auto manufacturers, and they'll also provide the batteries for those cars. That is a toll, where they have control over the market because they're providing the supply to their own competitors. The fourth moat is the loss you get by switching. Tesla does this amazingly. They're so vertically integrated that when someone buys a Tesla, they go ahead and they get the power wall installed into their house. They get the solar roof panels because it all makes sense. There's such a large cost for them to switch brands that they just stay with Tesla for everything they get. When someone buys a Tesla, if they get solar panels, then they're charging their car for free and they're using utilities for free. If they get a power wall, they're also storing the energy they get from their solar roof so they can go ahead and use that power pack anytime for free energy without paying any bills. It doesn't make sense to change because you're gonna lose out. There's actually gonna be a cost for you to switch now. The last moat is the price moat. Amazon does this, Walmart does this. They cut their costs so low because they can afford to do so when you're a giant. And Tesla's in the process of continuing to lower and lower their costs so no one can compete with them on price. That's another moat. When you have the lowest prices, no one else can compete unless they offer more value. The second thing we need to look at is the future trend. Is the future trend in the company's favor? As an example, for Tesla, battery costs continue to decline. As each year goes by, it gets cheaper and cheaper for Tesla to produce vehicles, which means at some point it will only make sense to fully transition to EVs because it won't make sense anymore to be too expensive to go with an ICE vehicle. That's one example of future trends being in favor. Another one is with Virgin Galactic or SpaceX. The future is space exploration, and that trend is in our favor. Another trend are the environmentally friendly companies. There's a big push for more and more focus and importance on environmentally friendly companies. Another one is the gene editing process. That's why I'm interested in ARKG, which is the Genomic Revolution ETF by ARK Invest, because there's a future trend going in favor, making it cheaper and cheaper to go ahead and do more gene editing, make that cheaper and more available to mass markets. The third thing to check out is the leader or the CEO. We're looking at Elon Musk for Tesla. We're looking at Jeff Bezos for Amazon. We're looking at Mark Zuckerberg for Facebook. We're looking at Larry Page for Google. We were looking at Steve Jobs for Apple. We were looking at Bill Gates for Microsoft. Research the leader or the CEO because they are the visionary. They are the one who is ultimately guiding the company at the end of the day. You want to know everything about them. Watch all their interviews. Just see how they think. If you agree with how they think and you put your trust and belief in how they think, how they operate, and they have a good track record, then you're gonna want to possibly invest. But you're gonna continue down the list before you do so. That's one of the reasons why I became so confident in ARK Invest and all of their ETFs, because I looked at all the material on Cathie Wood and all the people in management. And that's gonna be the fourth thing to look at. It's management. You wanna look at not only the CEO, but look at everyone one step below the CEO. Look at the CFO. Look at everyone one layer below the CEO. See how those people run the company, because those are the people who are actually putting things into place and making sure things are running smoothly. However, the CEO is obviously guiding those people. We should want to be equally as confident in the management team as we are in the CEO. It's very easy to take a look at the management team of any publicly traded company. So you can just do a quick Google search and see who are the top key players in the management team. Number 5 is going to look at the past growth rate. Look at the past revenue growth rate of the previous years. Not just the financials, not the profit, because if these are innovative companies, we can't really expect them to be highly profitable or profitable whatsoever. But we want to see a trend. What we're looking for is, are we seeing a really fast growth rate in revenues year over year in the past years? And then with that, we'll take a look at the financials, which is going to be the 6th one we're going to look at. So if we look at the 6th thing, the financials, how we actually look at financials is we don't look at whether they're profitable or not. We look at where the money is going. What are the operating expenses, and what is the trend of the operating expenses compared with the trend of the revenue growth. So we're looking at how fast is revenue growing, and then we're looking at how quickly or how high are operating expenses increasing. Second with that, we want to see how much money are they putting into research and development, because research and development is what's going to be allowing them to innovate quicker and quicker, which will then allow them to snowball and disrupt the entire industry a few years down the road, and hopefully become profitable and completely change the entire industry if we made a great decision. If you take a look at financials and you take a look at how much money is coming in, and then you see that as their revenue is growing heavily, they're putting more money into research and development and operating costs because they're growing their team. That just means that you know that they are using the money that they're getting from the revenues to be funneled into more growth. And that's a good sign. The last thing is to look at the mission and values of the company. Tesla's mission is to accelerate the world's transition to sustainable energy. Then you're gonna look at the values of the company. So you wanna search up the company's mission. What's their main mission? What are they looking to do? Then look at their values. What do they value the most? If you align with the values and the mission and you believe that that's a quality thing to go ahead and strive for, not only do you agree with it, but then that you also see that their actions in the past have lined up and matched the goal of the mission and their values, then you can go ahead and say, this is a good company, I'm going to invest. If you look at the past metrics I just talked about and you get green lights all the way through. This is personally how I research my potential growth companies that I'm going to invest in. And this is based on reading multiple investment books, watching lots of YouTube videos, and reading articles on Seeking Alpha and other business pages. If you found this video useful, please give it a thumbs up. I'd really appreciate it. Subscribe for more financial education videos just like this one. It's my goal to help you accelerate your wealth building journey. Again, thanks for watching, and I'll see you in the next video.